Hello, my name is Andy Barcade, and I am the editor and publisher of the Think to Retire newsletter. Thanks for spending a little bit of your time today to listen to the video I've titled Risk Management Indicators. The risk management indicators we have inside of our newsletter are a very important part of what makes the long-term success of our subscribers. It's tied very directly to our adaptive investment allocation model, which we'll talk a little bit about. So let's go ahead and get started. Okay, markets, as most of us know, have some identifiable trends. They tend to have patterns. They tend to have personalities, if you will. And again, some of them negative, some of them positive, and these will always change from time to time. Sometimes the trend will play out over months, maybe even years, only to change sometimes suddenly. And the idea of the risk indicators is to watch and analyze the market metrics, the market data, to keep us on top of these trends so we can actually be in the markets when the trend seems to be positive, and when things start to change, we want to back out and be much more defensive to control volatility. And again, one of the biggest premises of our whole newsletter at Think to Retire is to control risk and control volatility. We believe we will win more in the long run if we can actually take a lot of the downside out of the equation. Okay. Again, the whole idea is to avoid disaster, to make the ride smoother. We want to capture most of the market upsides in increasing markets and avoid most of the downside in the declining markets. And notice I said we're not trying, this is not timing the market, this is not a get-rich-quick scheme, this is not perfect. It's designed to be driven by math, it's designed to be very data dependent. So again, the decisions are made with math, not just, not at all opinion or emotion at all. That's completely taken out of the equation. Again, the whole idea is to be on the sidelines when markets look bad and when they continue to look like they may have the probability of continuing to decline. And when things look a little bit better, we want to step back into the market. And we'll show you a little bit about how the indicators will do that. Now, some of you out there may recognize this person, Benjamin Graham. Unfortunately, one of his biggest claims to fame, at least in popular culture, is he was Warren Buffett's professor at Princeton. And Warren Buffett has said many times he's learned everything he knows about investing from Benjamin Graham. But Ben Graham said many things. And one of the things he said, which really, I guess, capture the whole idea of the Think to Retire newsletter, is this quote here. The essence of investment management is management of risk, not the management of returns. And if you think about that for a while, I think it makes perfect sense. We are trying to win over the long run by reducing risk and missing most of the downside of these markets. Notice I didn't say all of it. We're trying to actually let the math tell us when these downside movements look like they have the probability of continuing, and then you want to back out by using these risk indicators we're going to talk about. Now, this is about a 120-year chart of the market. And you can see there's definitely defined periods of time where the market increases, which are in the green, and there's definitely long periods of time where the market either declines or goes flat. And the reason I show you this is they're pretty much arbitrary. If you happen to be retiring or close to retiring during one of these periods, whether the market goes flat or goes down, being able to use your money for income can be very problematic, as you'll more than likely spend your money down and run the risk of running out. So avoiding a lot of the downside is very important to the longevity of your accounts and the success and happiness of your retirement. Okay. Again, I mentioned earlier, markets have personalities, which is kind of a funny way of saying that what works today may not work tomorrow. They tend to favor certain sectors, certain asset classes, certain industries at certain times, and then shun others. And that's a constant rotation based on what's happening in the economy, what's happening around the world. The economics are always continually changing. Markets develop over a long term. They tend to have definable trends. And again, it's the idea of the risk indicators to look for those trends and actually either be involved when the market looks relatively strong and out of the way when things look a little bit weaker. And the whole idea is to reduce risk, like I keep saying. Okay. I think we need to look at the AIA, the Adaptive Investment Allocation model, and describe it a bit to understand how the risk indicators work in conjunction with it, because they do definitely work in conjunction specifically with this model. Now, the Adaptive Investment Allocation is designed to look at and rank different sectors of the market, different asset classes, different industries, and keep us in the stronger relative strength performing sectors and asset classes consistently and away from the weaker ones. Now, again, it's a rotation. What happens in the world, what happens economically will change what sectors and what asset classes the market tends to favor over time. And again, our goal at AIA and the Think to Retire newsletter is to constantly supply you the stronger sectors, the ETFs to be in, the mutual funds to be in the areas that are exhibiting strength, and stay away from the ones that are exhibiting more weakness. And that's an ongoing rotation. Now, in positive market environments, we're going to want to be actually allocated to somewhere between maybe 4 to 6 either exchange traded funds or mutual funds within your 401ks, 403bs, mutual fund families, or brokerage accounts. And during negative times, negative market cycles, and these are defined by the risk indicators, we're going to back away and be in more safer assets, such as money markets, fixed accounts, maybe fixed annuities, short-term bonds, those types of things. Again, take risk off the table and pretty much just sit on the sidelines and hunker down for a while till things look better. Okay. There's 2 different risk indicators. There's T2R, or Think to Retire 1 and 2. 1 is more of a long-term indicator, watching the market over months and years and trying to draw some distinctions on if the market's in an up cycle or a down cycle. T2R 2.0 is more of a short-term indicator, a risk indicator, kind of the canary in the coal mine, and they work very well in conjunction with each other. Now, it's important to understand that they both have to be positive for us to suggest being in the market and allocated in the sectors and the different asset classes of which we would provide you in your monthly newsletter. If either one of these turn negative, we're going to send you an alert and we're going to back away and go into safer areas, because that indicates we may be going into a period of market distress, which we want to sit out and miss. Okay. Some of the data we're looking at, and this is just some of it, and this is all done behind the scenes, and it's done every day, and you're presented the data, actually not the data, but the outcome of that data in the form of the specific exchange traded funds or mutual funds to use in your accounts. They're going to look at new stocks that are hitting new highs and new lows, different moving averages that are watched, 200-day, 50-day moving average, advancing declining volume, advancing declining stocks, the relative strength of cash versus other market sectors. These are all looked at to judge the demand of stocks. Is the demand for stocks going up or is it going down? That tells us a lot, and a lot of the data surrounding the market is actually what we're going to be looking at to make that call. Okay. Trying to identify a market trend, you're going to look at and you're going to consistently analyze this data. These data points I mentioned, and there's multiple data points, are looked at every single day. And they're trying to judge if the current direction of the market looks like it is going to continue going in that particular direction. In other words, if the market is in an uptrend, does that uptrend look like it's going to continue based upon the data that's being analyzed around the market? So let's just say, for example, we have an uptrending market and the market decides to dip, and it does all the time. Markets don't go straight up or straight down. They tend to have a stair-stepping pattern. And if the market has a dip, maybe a bad week or a bad couple of weeks, the data is going to judge, is this just a head fake and the market still looks strong and we should still stay in the market? Or is this new dip in the market, does it display the data and does it look like it's got a change in trend that could possibly be happening? And then one of the market indicators may tick off and we would actually back out of the market and kind of hide for a while, because the probability of the market changing trends is strong. And the vice versa on the way up. If we're out of the market and the market starts to go up a bit, the trend indicators, the risk indicators are looking at the data surrounding that upward move and judging, is this upward move a change in trend that the market looks like it's going to continue to go back up, or is it just a head fake and the market may continue to go back down later? That's always being judged. And again, that's happening in the background. All the data that's being crunched is being done outside of what you're getting, but you're going to get the actual outcome of that information in the form of the particular areas to actually have your accounts go into. Okay. These are a couple of charts that kind of show you how the risk indicators have worked separately and together, because the T2R1 and 2 work very well together. They work separately pretty well, but together they add a different level of growth and safety to the accounts that we've used. Now, this is showing AIA moderate. This is a mix of 40% of a person's portfolio be in the AIA strategies, in the models that are suggested, the ETFs or the mutual funds that are suggested in the monthly newsletter, and the other 40% of a portfolio being in safer areas like money markets, CDs, fixed annuities, T-bills, short-term bonds, something like that, but out of the stock market. Now, as you can see, the gray line is the S&P 500. The blue line is the AIA moderate. You can see how it's outperformed over that period of time, which is roughly 2001 to 2020. The market averaged 6.96, just about 7%, and the model was about 9.6, so about 2.8% higher. But what's even more telling is the volatility control. If you look at the maximum drawdown in the red box off to the right, down here, the worst drawdown, the worst dip the S&P had during that period of time was back in 2008 and 9. That was the mortgage meltdown. It was down over 55%. Now, the same maximum drawdown for the AIA moderate index was actually about 21.7, and that was actually 2020. So again, cuts the volatility down, and by doing so, by taking out a lot of the loss, the gain takes care of itself, we believe. Okay, now let's go to actually using both indicators together, T2R1 and 2 together, and you'll see how it enhances the volatility control as well as the return. The same AIA moderate growth index is here. The S&P 500, again, averaged about that 6.96, but look at the difference of rate of return. It went from about 9.6 to about 12.6, quite a bit difference in the long-term return. And even more telling, look at the risk indicator, the risk profile, the maximum drawdown down here in the bottom right corner in the red box. Again, the S&P 500 still had its maximum drawdown, maximum drop of 55% back in 2008 and 9. But again, the risk exposure, the loss, the maximum drawdown for the AIA using both risk indicators was just shy of 10%, 9.9. So again, it's reduced volatility by a long shot, and by doing that, we believe it enhances rate of return. Let me just point something out to you. If we see on the graph this dip right here, and it's kind of hard to see because it doesn't look very steep, but that is the 55% drop the S&P took in 2008 and 9. And if you see here, the risk indicators of AIA got us out of the market before those losses became too much, and we avoided the lion's share of those losses. And hence, we didn't have to make back 50%, 55%. We were already in a safer area. And again, when we got back into the market, we got back in at a higher level. And again, it just kept growing higher. So by reducing the downside that you have in the bad markets, that only enhances the upside we'll have over the long run. Okay. Again, we've gone through this. I would like you to go back if you could. I hope this explains things a bit better. If you'd like to actually sit down and have a couple of some conversations, you can set up a demo. You can set up a coaching call. You can go to our website and do this. We'd be happy to have the conversations with you, whether you're just kicking the tires and thinking about maybe you want to become a subscriber, or perhaps you're already a subscriber and you just want to gain a bit more knowledge about how to best use our Think to Retire newsletter. Listen to the live demos we have. Listen to the monthly webinars. They're designed to bring you up to speed on what's happening today and talk about the newsletter and the best ways to use it. We're very much bent on trying to make sure our subscribers can use the newsletter the most effective way to make their outcomes the best they can possibly be. So again, thank you for your time. I hope this answers some of your questions, and by all means, go watch some of our other videos, and hopefully they'll answer some other questions you might have. Thanks again. This is Andy Barkate, the editor and publisher of the Think to Retire newsletter. Enjoy the rest of your day.